In 2012, the European Central Bank was facing a crisis, and its then head, Mario Draghi, had only 3 words: whatever it takes. He promised to defend the euro, ensuring a future for the currency. The warning worked then. 10 years later, it is the end of another era for the central bank, marking the end of negative interest rates in the Eurozone. It has raised interest rates for the first time in 11 years, a more than expected hike of 50 basis points. So while the ECB was late, it clearly arrived to the rate hike party with a bang. Recession fears have pushed the euro to a 20-year low against the dollar. This adds to the European Central Bank's task. It also comes as worsening energy prices are driving inflation. This is because oil is priced in dollars, but consumer prices rose at a record 8.6% in the last 12 months. That is well above the bank's 2% target. Raising rates is seen as the standard cure for excessive inflation, but rate increases can often slow down economic growth. Currently, this is the goal for central banks around the world: to get inflation back down to acceptable levels without tipping the economy into recession. It is a tight line that they have to toe. It is also very difficult to get this right after a decade of very low rates and inflation. And the ECB is not alone in this conundrum. Central banks around the world are trying to do the same. In June, the US Federal Reserve announced an interest hike of 75 basis points, or 0.75%. It is the biggest increase since 1994. Reports suggest that the Fed will opt for another 75 basis point rate hike next week. The Bank of England also moved to curb inflation with higher interest rates. Even Switzerland's central bank surprised with its first increase in nearly 15 years. However, there are other concerns in the Eurozone now. Many are worried about how higher borrowing costs will affect European nations, especially the ones with huge debts like Italy and Greece. And joining us on the broadcast is Daniel Lekel. He is the chief economist at the Tresses. He's joining us live from Madrid. Daniel, good to have you with us. What is your reading of this latest move by the European Central Bank?
It was a very needed increase of rates. The level of inflation in the Eurozone is at a level that was not seen since the early 90s. And not just headline inflation because of energy prices, but core inflation also at the multi-decade highs. So it's imperative for the European Central Bank to increase rates, reduce liquidity injections, and take away part of the stimulus that has been implemented in the last 2 years in particular, which have been phenomenal. So I think that it was a much needed move. I think that we have to remember that the rates in the Eurozone are going to continue to be extremely low. So the European Central Bank remains very accommodative, and the weakness of the euro proves that the market is also perceiving it this way, no?
Right. You said at the outset that this was a much needed move. Do you think that this could have been done a long way back? Is that what you're saying? What do you make of the timing?
I think that the timing was too late and too little. I think that the European Central Bank had a few times in the past when the economy was growing strongly and when there was a big recovery of the European economy to increase rates and to normalize policy. Unfortunately, it kept very aggressive negative rates and liquidity injections for too long. And that is partially one of the reasons why inflation is so high in the Eurozone. And just think about, for example, the difference of inflation between the Eurozone and Switzerland, which have the same exposure to energy prices, to the Ukraine crisis, to the different problems of supply chain disruptions. And the difference in inflation is 3 to 9. So I think that it's important that the European Central Bank takes inflation seriously, because core inflation at the levels at which it is right now in most countries of the Eurozone is extremely dangerous for the economy.
Right, we're leaving it there for the moment, Daniel. Thanks very much for joining us on the broadcast and sharing your assessment.
Thank you.
WION now available in your country. Download the app now. Get all the news on the move.